Let's talk about paying off that mortgage. Yay! In this video, we're going to talk about 3 strategies. The original mortgage with nothing extra, velocity banking, and the principal paydown method. Way better. So I had a viewer reach out to me and he asked for me to do an analysis for him on a $425,000 home with 10% down at a mortgage rate of 6.625%, using a line of credit of $12,000 with a line of credit rate of 3%, which I asked him how he got that rate and he didn't respond, but it seems a little low. But nevertheless, I'm going to run the numbers with these figures. All right, so to start, the original mortgage only, okay, is $382,500 at 6.625% over 30 years, is 360 payments, almost $500,000 in interest, more than the house itself. Or he's asking, well, what if I did the velocity banking method, also known as accelerated banking? I'm seeing so many terms out there, by the way. Okay, as a reminder, velocity banking is using a line of credit to pay down the original mortgage in chunks. Okay, you take out the full balance of the line of credit. You then pay down that balance with 100% of your income, which is, by the way, the reason why this looks like it works. And then you take out your expenses from the line of credit and you're left with an ending balance, which you pay an interest rate out of, obviously. And the theory is that by putting in the chunks, you're lowering your mortgage value or your balance and you're paying it off earlier and with less interest. That's the theory, at least. Now, his rate was 3% with $12,000 available. When we do that, you'll see that this loan, the mortgage, is paid off in 169 months. And the total interest is $204,000. Now, this includes the interest on the line of credit, assuming it's still 3% over that 169 months. Alternatively, he asked, well, what if I just put the $1,000 a month into the principal of the mortgage? That's where this comes in. And your total interest is $211,000 over 173 months. Okay, so let's summarize. This is the summary of what we discovered here. So, original mortgage, 30 years, almost $500,000 in interest. Velocity banking, 169 months for $204,000. Principal paydown, 4 months more, and nearly $7,000 more. Okay, so it appears to work in this example. However, how is this individual getting a 3% interest rate when SOFR, which is typically the benchmark, is 4 1/3? So typically, let's add about 3% to SOFR. This is more likely what the rate is for the line of credit. When we do that, you still win with the velocity banking. But here's where the devil is in the details, ladies and gentlemen. Under this velocity banking method, you'll notice that there's still a $421 balance at the end of the 12 months. That's $35 a month over the whole year. So you got to find this $35 somewhere. Well, that means we have to lower our expenses, right? Let's lower our expenses by $35. It's going to be a little bit less, but more or less, that'll finally get you at even where you don't pay anything. When you account for that, all of a sudden, you're only saving $500 with velocity banking. $3 a month of savings. Woo! It's just not enough to justify this. This is a lot of like workaround math to do all this work and not really for much benefit compared to just paying down the principal. I also wanted to highlight, typically an American family lives in their home for about 8 years. That average might go up recently because of the low supply of homes. But how does this all work if somebody were to live in their home for only 8 years? So let's take a look. With the original mortgage, after 8 years, $192,000, velocity banking, $160,700, principal paydown, $161,300. So yes, you save $590 for those first 8 years of the mortgage, about $6 a month. Woo! The velocity banking, accelerated banking, whatever, it's not really doing too much more. You're taking all your income, you're paying it towards another loan, as opposed to just doing the principal paydown method. And I would argue that it's actually a little bit more dangerous. You're opening up yourself to more debt that's available to you, and you could possibly lose a little discipline once in a while, end up spending more of that line of credit on other things. So listen, the risk is real and the reward is very small. I'd be careful about the velocity banking. If you're looking to lower your mortgage or pay it off faster, it's probably better just to pay down the principal. I hope you find some value in this. Have a great day. Thanks.